Hello YouTuber, today we'll do the Adobe. The ticker name is ADBE. The stock analysis will do very deep dive into the stocks in this video because this is a very reputed company and I didn't see any flaws. So I also go very deep into the models, do some valuation to find out the intrinsic value as well, because right now the stock is all-time high. So we'll see whether it makes sense or how the financial supports, but we'll go step by step as usual. We'll peel the layer of the onions and see how far we can go from the different dimension, not just from the valuation perspectives. Okay, so let's get started. Okay, just a small introduction. So myself, Pramod Kumar, I am a CFA charter holder and FRM certified, and this is my website, riseanalytics.ca. So this is the agenda for today. So this is the ticker name ADBE, and I'll give some little introduction. I think this is nothing, it's just one slider here, but then we'll go straight into the financial trends and PRAT models and free cash flow to find out the intrinsic. Let's see if it has any share repurchase and try to make my opinion. And then I'll also insert some of the ratios like liquidity and returns, the historical trends later on as well. Let's see. So this should be the interesting journey. Yeah, and last not the least, sorry, and thanks for this ticker is suggested by one of our YouTuber investor, hopefully the member. So, but I saw in the comments. So that's one of the reason I did it, and I was also planning to do the Adobe. So since I got the request, I thought why not just do it first. So thank you for your comments, and if anybody is watching and like my video, please put the comments if you want me to do your stock analysis. Okay, so let's get started. So what is Adobe, right? So Adobe is basically it's the three segment of the business, right? So first segment of the business is the digital media, then digital experience, and it's more on the publishing side, right? So on the digital media is their main core business, right? Where they provide tools and a solution, basically Adobe illustrators and all those kind of Adobe products. And then digital experience, creating and measuring, monetizing the customer experience from advertising to commerce, right? And as what it's mentioned, but we know from the that this is a fairly reputed company and it's been there for long. So if you want to know more, you can go on to the website, but that's how their financial is categorized into, and the company is categorized into three main categories. One thing I really like about this is that they have switched from the not switched, but basically getting more on the subscription model. Let me hide myself so you can see much better slides. Okay, so let's get started. So if I go to the financial, so as you see, this is in their dollars in millions, right? So from 2019 to 2018 and 2017, right? This is the percentage of the revenue. So if I go from this is from their 10Ks, right? So it's the 69% of the revenues from their media business, and the experience business is 29, and just the 2% is on the publishing, and it's decline if we see from the comparatively from the last year to this year. But overall, the growth in terms of the revenue is 24%, which is good for this company. If I go to the media and overall, so overall the digital experience is doing good, and it's not bad, right? 30, it's just dropped, actually it's 22% up as well. So each range is growing up, right? So that's, so from experience, media is going from 22% from year over year trend, and experience is going into 31%. Okay, if I go from the diversification perspective, because one of the reason I put this slide is because from the dimension, right? If, for example, American market, or maybe, right, which is the very big market, but because of coronavirus it get impacted, right? So if that market for sure is impacted, but you'll see still most of their revenue is not only from America, right? It's from the EMEA region and the APEC, Asia Pacific region as well, which is uh, close to the 40%, right? A little over 40%, 42%, 27 and 15%. So they have, it's very well diversified from that perspective. So that's one. And second thing, what I also like about this, if from this slide, is that each region is growing, right? As most of the time I see, notice one region is growing, other is not growing, but here most of the region are growing pretty much on the same pace. Although their America business is a major chunk of business, which is 58%, but look at the growth from the year over year is 27% in terms of the dollar revenue, right? Similarly, on the APAC region, which is the smallest region, and look at the growth, right? 24, almost closer to the, so overall their average growth, right, which is 24. So this means they are growing pretty good in the APAC region as well, right? And other region is not bad, is over, it's 2 digits as well, right? 15, little shy over 20%. So that's why I have put this slide as well. Now we'll go more into deeper into the financial common statements, and then I will go to the models to see what's the actual price, and then goes there. So from this is news. From these videos, I introduce some new slides, and if you like my videos, please give a thumbs up. This is also just a reminder. Usually I forget and only ask at the end, but do give a thumbs up so Google algorithms will say think you like it, and then promote the videos, and more will join this investor community, right? Okay, so on the income statement, right, so what it's trying to show here, so these are in millions from the left side in the dollar amount, and these are the year. So this is now TTM is until now, and this is 2019, 18 and 1 year. So Adobe published their year-end statement in November, so that's why it's November 19. So from revenue is all major category I'm showing here. So the revenue you see is spikes. There is no drop, no up. So it's consistently drive. So that's what I like about this company so far, is consistency. Consistency is the key. Seems like they pick one area of the business, right, and they're leading into that area. So that's the key here, right? They stick to one rather than when I did it, although it's not a direct comparison, but last video which I did it on the Square is a very hype company, but they're all over the place, right? So stick to your core business and excel it, and then once you excel, then go somewhere else. That's what my philosophy is. But here I didn't. Here I see that, but on other video I didn't see. So, and the financials so far looks very good and very clean as well. Okay, on the operating side of the margin, which is on the orange slide, income before taxes and after taxes. So we can see there is only slightly going into the taxes, but overall they are retaining larger portion as a bottom line, right, which is shown in the yellow color, and it's keep growing as well, right? It's keep consistently growing, so which is a very good. So that's all from the income statement. We get it in one shot. Let's give very good view of that. Okay, now going from the operating margin to the profit margin. So this chart goes a little bit deeper into that. So operating, so this shows the total operating percentage in terms of the percentage rather than the dollar terms. So the operating margin, when we are interested in, goes from 30 and going over and touches even going over 60 right now, right? And the year end of the last year, it's little below. So look at here, right? And similarly, the bottom line is going and touches and is going only 31, seems like 30 or 31%, right? So here, so that 30% net operating margin, right, it's very good. Or even if you see from it's always, if you see here in the past 4 years at least, it's 20 or over 20% net of profit margin for this pretty long history of the company, right? So and the company is pretty long. It's not like a new company, right? So a lot of growth in the company, and which I also notice when I run the model and try to get its growth, give me the growth of the short term or the long term perpetual basis. Model gives the quite a good growth as well. Okay, let's continue. Okay, next is on the cash flow. So this is all three cash flows, just one shot. So we don't have to look multiple slides. So good thing on the operating cash flow side, you see is consistently positive. So I'm pretty happy seeing that. On the financing activity, you see this is negative. So what it's trying to say, I'll keep it as a surprise, this as a last slide, but basically they're not raising any money, right? So that's one thing I'll say, okay. Okay, so that's not bad, and they are doing some investments, so that's why it's negative. But overall, the profit margin is positive and it's increasing. So, is the liquidity ratio. The liquidity ratio, honestly, what I think is not very happy with it, because it's shy even to touches to the one. So even on the current ratio side, the quick ratio or cash ratios, it was much better in 2015. Actually, it was way over even 2015, because it's over almost like 200% of their current liquidity. But now it seems like they have a little bit, they have more short-term debts as compared to the current assets. So that's not even one, right? So that's what is trying to project me. But when I looked into their free cash flow and cash flow growth, they have enough cash flow there, and I'll cover in the next slides. Let's go to the models. Okay, here I'm showing you the PRAT model. In the PRAT model, basically is a very good model. If to try to, let me zoom it out a little bit, is very good model to show all the data at one point. So what I'm trying to show here is what makes their the returns, right? What's make their returns, how they're coming up with that, right? So if you see from so this is the old and this is the new, and the new is basically, you see it consistently improves, right? It's a little bit shy from the last year, 2018 to 2019, right? It's the 26%. The operating margin, which is EBIT margin, is increasing as well. So, but it's a little bit shy from 2018 again. And the tax burden, tax burden is much higher is better. So it's 92, which is way good. Asset turnover can be better, but it's lower, right? So assets are not generating as much as return. Maybe because we have noticed they have doing heavy investments. So because of the cash investing is negative. So maybe that's one of the reason. But overall, if I compare with the 15 to now, or with the previous year, it's much better, right? But it can be better. Financial leverage sides, I'm fine. It's not that too high. It's okay. So, and also if you compare with, so basically what's driving their growth is pretty much is the operating margin, right? And the tax burden, right? So that's what driving their growth. So that's one thing. And the net profit margin as well, because it's very high. If I compare with the past 5-year averages, so you can see easily all the ratios are doing very well. So this means the company is doing well, or whoever is the chief financial officer of the company, he is doing his job pretty well in terms of the retaining, increasing the margin and operating margin and so on. So that's what it's very clearly shows with this model. Okay, and let's go to the financial free cash flow. Okay, so this financial free cash flow, which I'm showing here, I'll usually won't show this, but I thought maybe why not just share this information as well. So this depend upon each individual. So these are the models, and depend upon what models you put inside it, what the number parameter, that the parameter you will get the different answers, right? So, but my required return, so there are two major returns, two major or components which we need to feed it. First is your expected requirement return. So this is the requirement return. I use the weighted average capital and the kappa model to come up with that. So I expect, because of the market is not doing right, so 9% for the overall index, the broad-based index, but usually I put 10%, but I was a little bit give the relaxation on that point, but not very much. So for this one, when I put my data into the model, it comes up the required return, which is, you see, is pointing to the another sheet, is coming 8.4%. So it's not very, so it's still high, but it's not very high. I think the company growth and all it can give. Okay, so that's what the model gives. The second aspect of it, so I use the two-stage model here from the financial free cash flow perspective. So first, when I take the short-term growth for the 5 years, the model is giving me I use the two different models for that. So that, and then I compute the 50% ratio, right? So I don't think it should be good to go into the math behind it, but what I'll got from there is 17.38% growth for the short-term perspective, and then I am reducing that growth, basically just doing some linear interpolation here, reducing that growth to 6.41 perpetual basis after that, because the company is doing well and it can generate that. Another thing on the third thing on the free cash flow basis, I didn't add any borrowing, and also a little bit on conservative on that side. So you see my required return is high, but because I do see there is a growth in the company as well, but it's not high. But usually if the market is good, maybe I'll put my more higher number, but I'm fine with that kind of my requirement. But when I put this, and then this is just the present value of that, and I'm just projecting this for 5 years. So I got this total value, and then my per share, when I divided by the shares, I got like a $522.93. So that's what this number comes up. This is my value. And if I go outside to the market, that number is coming as to $427, right? So that's one number. So that has quite a difference as well. So from the safety margin, seems like based on the growth, so that's what even explained, and which we have seen in the earlier. So maybe some people can say, okay, maybe I want the lower than, because the economic is not doing well. It's all depend upon how much growth is coming, right? Even if so we have put the required return lower, and for that as well, but we cannot have very low from the short, because we do have some company, because this is a broad-based revenue coming. So I cannot just put based on one US economic, like if it's doing 2% or 3%, that will be penalized. Otherwise, if I put that low number for the growth, for the perpetual growth, this implies that, because this is just for the few years, I'm not doing it for forever, like 15 or 10 years, right? For the low period, then there won't be any difference between Google, Apple, and some XYZ company, right, who is already at retiring, and some other phase. So there are companies, it do affect by the broad-based a little bit, but not that much, right? But this is what the model gives me. So for that, maybe even if I cut the number. So now, even if we go very pessimistic, which we should not even go, but let's say if I do, okay, very bad company did it, so that's what I have that's why conservatively I didn't keep it consistent 17 or 14 for few years, usually if I do broad. But let's go very bad scenario, right? So this is the this is more like average scenarios, but let's say very conservative scenarios. If I do like a 5% growth, right? Perpetual growth after that, still my value is of intrinsic value, right? It's coming higher, over almost like a $70 or more, right? Higher. So if I do the math exactly to tell you, so this minus this is $80. So we have good safety margin here, right? But I think based on how the company is doing on the subscription, I think the number I'll still stick to that, at least from my perspective. Okay, so let's go next. So the next big thing what I like about the company is because we have to not see just the one number price perspective, but from the overall, that's what I look when I invest into the companies. From the companies doing the share repurchase as well. So is claiming that they have done recently some share purchase, but they have put aside to authority has got $8 billion, right, in the common stock in 2018, and it's still they have us to do until the fiscal year 2021, which is 1 year from now. So that's a good, very good sign as well. So if nobody do what, at least company has enough money to go and do it. They only did until now $5.3 billion, right? That's what it's mentioned here. The total still have over 2 billion to invest. So if I see from the return perspective, you see the return is quite well. This is the top level return. So first one, the blue color is the investment capital return, right? So whatever the capital we have deployed, so after removing all those cash and also how much returns we are getting, so the return is consistently increasing. The return on assets is also consistently increasing, and the return on equity, which is also increasing, right? So now it makes more sense when we see all our deep dive models and also that why this top turn, this is not like a drop or anywhere, and it's increasing. So so make sure, so let's see what we have next. So from this perspective, right, the opinion perspective. So opinion perspective, what I'll see that maybe market is taking into the PE ratio is quite high. The earning is right now is low, is 56. On the, if I see from the enterprise side and EBITDA, if I compare, it's also high, right, from the historical average, right? But our valuation numbers looks good. They are doing good job in their whatever in sector or industry they are. The beta is not that bad, it's low, and but the stock is all time high. But if I compare with this, inverse it with the PEG ratio, right? So it comes around less than 3, so 2.28 or some, right? So it's this mean although this is, so it's under 3, so which is pretty normal, I believe, for the growth companies, right? So that's what market is factoring into growth. So I believe from the investment perspective, definitely it's a very good stock from the long-term perspectives, and the company proved itself in the past, and from the financial and other factors we have seen. So that's what my take on this ones. Maybe we can wait a little bit if to bought it, because to see if the price can come down or maybe some wave will come. So what do you think? Let me know your comments below on this stock, and are you planning to invest soon, or you'll wait, or if any other stocks you want me to cover. And please, if you haven't liked it, this video so far, like it and subscribe to the channel, and so more and more people will watch it. So give a thumbs up. As many thumbs up you give, the more people will watch. Thank you again. Thank you for the person who suggested this video. So the ticker. So that's why I have made this. So thank you very much, and see you soon in the next video. And bye for now.